Thank you for coming. My name is Philippa Thomas. I'm a news presenter, news anchor for BBC World TV, and I spent quite a long time as a Washington correspondent, White House reporter, traveling in North America, so that's my particular interest. I'm very pleased to say, though, that I don't have to have the answers on the economy, but the gentleman with me will be able to help us out, and I'm going to introduce from my right, Jonathan Blair, co-chair and UK managing partner, Womble Bond at Dickinson, which has become one of the global top 100 law firms. Ross DeVol, formerly of Milken, some of you may recognize him, now Walton Fellow at the Walton Family Foundation, and his mission there is to build an entrepreneurial ecosystem in the American heartland. And I've just pointed out to him, there's a really good write-up of this aim, this project, in the New York Times today. They call it flyover startups. I don't know if that's the way you'd put it, but or rise of the rest. So that's an interesting angle. Steve Krouskos is Global Vice Chair, Transaction Advisory Services, EY. He deals with multi-billion-dollar cross-border transactions. And one of the things Steve is going to be doing is urging us to look again at the way we measure economic value. You know, what are we basing our debates on? William Lee, former head of North American economics for Citi, is now chief economist at the Milken Institute. And Tony Fratto, former White House deputy press secretary, founder and partner of Hamilton Place Strategies. I've just said to our panelists after our opening thoughts, there is so much to go through that if they feel they need to nip in on each other and be lively, I think that's good, because I know we have some divergent views about where the US economy is now and just how sound its prospects are. What I'd like to start with, I'll also leave some room for questions at the end and welcome those just coming into our panel on big markets, big politics, the state of the US economy. I'd like to start with a spot check. Where are we now? Very interesting times with the tax bill through the Senate, likely to have reconciliation, markets feeling pretty happy, pretty buoyant. Should we be very confident or should we be more cautious? And I'm going to ask Bill Lee to start us off on that.
Thank you, Phil. The U.S. economy is something that's a bit of a mystery, right? I think when I was at Citi, I was telling all of our clients, we're barely at that takeoff stage because for the longest time, the recovery was based on the consumer. The consumer has been the driving force, and we had seen almost no sign of investment whatsoever. In fact, investment is probably at the slowest pace in post-World War II history. And now, in the last several quarters, we suddenly see a pickup of investment, and it's not just oil investment, which you would expect as oil prices recovered, but investment in equipment and in software and in the kind of intellectual property that drives productivity. And so I'm really quite optimistic that the US economy is starting to pick up. It's gotten beyond this meandering phase. Well, the key, though, is will it pick up enough to really address social problems, distribution of income, the low wages that have been driving the economy for so long, with low productivity, wages just have not kept pace with people's expectations. So as far as I'm concerned, I think the U.S. economy is doing quite well, but not well enough to address a lot of the problems that cause a lot of the social.
So, Bill, I'm going to ask you to give it marks out of 10 right now.
Out of 10, 8.
Okay, Tony? How many marks out of 10?
Well, I don't know if I could give it two scores. I think there's sort of a paradox in the way people are thinking about the way they think about the economy and what we're seeing with the economy, which is, I think, something close to a 10, actually. Look at macroeconomic indicators, looking at maybe a turnaround in investment. Certainly, consumer confidence, business confidence are all up and have been sustained. Asset prices are all high. The paradox is the way people think about institutions and their world, and about people are still not very happy generally. They're not very happy with their government. They're still worried about things like income inequality, right? Maybe I don't put it quite in that term, but they haven't seen a lot of returns to labor. But they are generally much more optimistic about the economics of the country, and they seem to be taking the signals on that. But they're not happy with their political lives. They're not happy with political institutions.
But so far we have an 8 and close to a 10. Mm-hmm. Steve.
Gosh, I'm probably at an 8 or 9. as well. I mean, I'm very optimistic. I think we could see GDP growth approaching 4% next year. Tax reform will get done over the next couple of weeks. Hopefully, we'll get a reconciliation between the House and Senate. That'll be 1.5 trillion of value into the economy. I think something that's not talked about often is the pace of regulation or deregulation. It's probably been about a 40% reduction if you look at just the number of pages of regulation that have been issued under Trump versus the Obama average over his tenure. And a lot of that has been to repeal some of what was put in place the last 4 years. So you're already seeing in areas like food and drug, mining, and other sectors, financial services, a positive impact that's impacting the economy. The one area I worry about is trade, and we'll get into that a bit in the panel, I suppose. But we live in such an interconnected world today, and with supply chains as they are, you have to try to separate, I guess, where we are in terms of negotiation, rhetoric versus reality on trade. But certainly, you can't afford to have the borders go up around trade.
And we will be getting to trade and investment, and we will mention China, I believe.
Possibly.
I want to bring you kind of inside-outside views now in that, Ross, you were saying, looking at the American heartland, but working for Milken for so long, you've been kind of looking at the way the economy has surged and fallen. And Jonathan has that dual perspective with the US-UK merger. So, Ross, first, can I ask you, out of 10, I'm a journalist, I can be crude, can't I? Give a kind of ballpark score for the US economy now.
I would say it's somewhere between an 8 and a 9. And I've been accused of being an eternal optimist in the past because I was one of the few that predicted that the growth pace would recover this year. A lot of that due to anticipation that you would see some deregulation in Washington. I talked to a lot of business leaders, CEO, and even small business owners. And this kind of gets to the debate we were having about a year ago about soft data indicators that looked very positive, but you hadn't seen the hard data respond to that yet. So you had business confidence improve. The National Federation of Independent Businesses saw a surge after the election, and consumer confidence is at the highest it's been in 17 years. But as Bill alluded to, and this is what I was hopeful, in fact, predicted would happen, we'd begin to see that soft data translate into harder data and good hard data. And if you look at equipment investment, especially in ITC and many other areas, there's been a real recovery in new orders in the past few months, the last 6 months, real upsurge. And I think that gets to, one, anticipating that there would be business tax reform especially, and it now seems increasingly likely. And just, as I said, an overall better deregulatory environment. And so there's still lots of uncertainties coming out of Washington, but I think there's the sense out there that you've had a tightening in labor markets, capacity utilization has improved somewhat, and it's not just the consumer that's leading growth any longer. The business sector has kicked in. And also, I think the US and the Trump administration has really benefited from a much stronger global environment, particularly here in Europe and in Asia. Japan's been doing better. And so despite all the concerns about trade, the dollar has come down and US exports have increased more than you might have thought. So, I feel somewhat vindicated in that I was out there on a limb predicting that the US economy would improve this year, and I believe it has, and hopefully we're on a higher sustainable growth rate now.
Okay, so we've got a very sunny outlook so far, and I'm going to introduce the word Brexit. Just with the thought that though we're talking about solid data coming through, it's anything but solid on this side of the pond, isn't it?
Yeah, it's interesting. We voted to join forces with our friends in the US literally the week after the UK voted to leave Europe. So, that was a pretty shaky time for us. We weren't quite sure what the reaction was going to be in the US, and certainly in that sort of virtual room, you could feel the tension rising. Was this a good thing or not? And of course, with Trump as well, you've got that more sort of closer to home type approach. So, Brexit was a bit of a mixed blessing, I would say, for us. I think entering the global markets right now is something, it's never been easier, frankly, with technology. You've got all the technology drivers. UK and US trade has always been good. You've got that strong cultural alliance between the two countries. Frankly, in the UK, we wanted to link up and hook up with the US. And in the US, the guys similarly wanted to hook up with us. So Brexit was, it was an issue, but actually in some ways it was also a facilitator, because as the EU, as the UK was frankly alienating itself from the rest of Europe, and so, you know, in the US, things were a little bit uncomfortable as well. We sort of looked to each other and said, well, we're the last ones, and maybe we should dance. And so, from our point of view, actually, I think it was a good thing. And certainly, I'm heartened to hear the 9s and 10s. Nobody gave it a strictly 10 quite yet, but I was heartened to hear the 8s and 9s coming out of that, because we're in a service sector, so we are very reliant upon strong economies. We want to see M&A activity. We want to see investment. And certainly, we're only a matter of months into our combination, but things are looking positive. And so for us, I would say Brexit was something of a mixed blessing.
Yeah. Well, and let's face it, I mean, for service businesses like yours and mine, Jonathan, I mean, while uncertainty can be bad in one sense, it also provides a lift, right, in another sense. Some of the populism and nationalistic tendencies we're seeing create opportunities to help companies navigate.
It is, and the amount of trade, historically between the UK and the US is, are we going to come on to trade? I know it is strong. The amount of FDI is strong. So uncertainty, the worry about uncertainty is people just stop doing things. And so actually doing something at a time of uncertainty is seen and perceived as a very positive step.
Although I do think that's been some of the drag from Brexit from the American perspective, though, is that there was a lot of hope to do TTIP, right? To do a broader trade agreement with Europe. That's stalled now. I mean, if there's one thing that Brexit has done, is it has put the brakes on a lot of conversations, including there was a lot of anticipation after Brexit in the United States. Some people who didn't quite understand what the UK was going to be going through relative to Europe, of trying to jumpstart a trade agreement, which was never anything that could happen until we understood what the UK's relationship with Europe is going to be. So that has slowed down. I've always felt like that on trade. I don't anticipate trade shocks. I think the global economy is fairly durable right now. The U.S. economy is very durable right now. Nothing that happens in trade, including, I think, NAFTA, although it would be very bad. I don't think it's enough.
You don't think that's vulnerable to at least renegotiate?
No, it would be, well, I think cooler heads are going to prevail on NAFTA. I'm very hopeful of that. I think if we just pull out of NAFTA, I think it would be damaging. But I still don't even think it would knock off a whole lot of growth. But I don't expect that kind of shock. What I do think is it's a longer term drag, right? To pull out of TPP, to put TTIP on ice. To be renegotiating existing trade agreements like Chorus and NAFTA, it has us looking backwards where most other major economies are looking forwards. I mean, Europe's agreement with Canada, I think, is a perfect example of moving forward, where the United States is looking backwards right now.
And that took years and years to negotiate.
Yeah.
Just from the point of view of NAFTA, as we've kind of landed there, Ross, I'm interested because obviously the hit or the perceived hit between the coasts was pretty significant.
Well, it certainly contributed to President Trump getting elected. No doubt about that. And back to Bill's comments about the kind of inequality, or the perception at least of inequality, and there has been. So there's a lot of concerns about free trade agreements and have they helped everyone. I don't think that we were as honest with people when we were discussing what NAFTA would do in terms of not everybody was going to be a winner, right? Overall, it would be better for the U.S. economy, but certain parts of the economy were hurt. And this has a lot to do with why I felt the opportunity to join the Walton Family Foundation and focus on the center of the country was really critical at this juncture, because of the schisms that have developed within the country. And some of the anti-trade rhetoric. I personally am cautiously optimistic that cooler heads will prevail on trade. Peter Navarro, still sits there whispering to folks, although you don't hear as much from him lately. I know him from my days in Southern California, and he wrote a lot about trade and China and how it's negatively affected the U.S. and policies
Maybe
to
President
change
Trump
it.
is focusing on the FBI, not NAFTA at the moment.
That's entirely possible. Maybe that's a good
He's
thing for the
switched.
United States economy. He not focus on NAFTA, but I think that something will be worked out. There'll be some changes made to it. The other thing I didn't mention that's really been positive for the center of the country and other parts as well has been the stabilization in oil prices, to oil and gas exploration in particular, all the way up to North Dakota. You've seen a very strong resurgence in Texas even, Oklahoma, and other parts of the center of the country, with prices stabilizing at 50, moving up closer to $60 a barrel. And this gets back to one of the reasons why capital investment has recovered in the U.S., partly because of higher oil prices.
I just want to kind of lay down a gauntlet for you all in the midst of this positive flow. The Washington Post editorial today on the tax bill. You might expect this from them, but they say it's an expensive tax cut bill that a country in the midst of an accelerating economic recovery does not need and over the long term cannot afford. Now, inequality and growing inequality was mentioned by one of you, and I wonder if any of you want to pick this up.
Let me jump in on that one, because you hear so often we should not have tax cuts right now. We're at full employment. We're on the verge of rising inflation. All that tax bill is going to do is feed inflation and push us beyond our productive capacity. And surely, if you give money back to consumers, one thing they'll do is spend it. Well, consumer spending has been strong, but it's been strong because the savings rate has gotten down to historically low levels. People have been spending more and more out of savings. So if you give them more money, I think the first thing they might do is restore their savings. So it's not clear that consumers would necessarily.
That's the
be spending.
ideal, isn't it?
You would, well, as I said, we're at historically low levels of savings. As demographics gets older and older, people are more worried about financing their retirement. And so with a big burst of income, no matter whether it's a few $100s, a few $1,000s, more of it, I think, will be saved than discretionary spending. The other thing is investment. If you look at how tax cuts work for businesses, if you incentivize investment, which is part of the tax reform agenda, then you're increasing the aggregate supply. Aggregate supply means you're getting more goods and services being produced, and that tends to lower the inflation rate. So if you sort of look at the tax bill and what it's proposing to do, the textbook analysis of the aggregate demand curve shifting out, that's not the knee-jerk response you should be having, but instead you should understand the circumstances of this recovery. This recovery has been 8 years of relatively low wage growth. People have been dipping into savings more and more, and I think it's time to start worrying about how the people will be reacting in the long run. And I think these textbook behaviors are just a little bit too simple to come back with that assessment.
Yeah, let me jump in here as well. Especially on the business tax side, you have to understand the perspective that Republicans have been proposing modernizing the corporate tax code and the pass-throughs as well for over a decade now. And this was not meant to be a short-term stimulus to the economy. This is addressing what they would call underlying structural conditions. It's not about, are you going to get higher GDP growth next quarter? The effort is to try and improve the competitive position. And the U.S. has the highest corporate tax rate among advanced economies in the world today. And businesses, corporations were increasingly making location decisions on where to place their new investments, largely based on international tax codes. And I think the idea is you make the U.S. look more competitive, and it's not that companies tomorrow are going to decide we're going to shift production back to the U.S. They're going to re-examine it. And so I personally don't see this on the business tax reform side as being a short-term stimulus. There will be some of that, But this is more of a longer-term structural adjustment.
Yeah. I mean, in some cases, it's not even possible to shift the manufacturing back in the short term because you don't have, you know, the unemployment or the potential employment to support it. It would take too long to get a factory up and running versus where you could perhaps in another part of the world, China, for example. So I absolutely agree with Ross. It is long-term structural, not short-term.
It's not, or it's not only about the electoral cycle.
I just a caution. I don't want to sound as though I'm a big optimist about the U.S. economy. I am nervous. I'm quite nervous about how tax reform can fail, and tax reform can easily fail if people anticipate that this is going to be a temporary measure. That means that the reactions that our models would tell us are going to be much smaller, much more damped. And the other thing is, the key to what I said earlier was investment has to take place. We have to have productive investment. If you survey CEOs right now, especially the larger firms, they all say, if given more money, I'm going to be giving it back to my shareholders because I don't want to invest right now. I don't see this great sense of profitable investments coming through, and instead I'm going to give it back to my shareholders. What are the shareholders going to do? The shareholders are going to go to some hedge fund or some other place to find high alpha, high returns, and so we'll have a wave of speculative investments going on. So that's, I think, the tripwire that we all have to watch for. So if firms don't invest and they instead try to give back to shareholders who then push it into non-productive investments, that's where I think that the problems will be.
So I think CEOs are playing a very difficult balancing act right now. I mean, to your point, there's an expectation to deliver back to shareholders, and there's certainly pressure from activists, which has been most prevalent in the U.S., but starting to see throughout Europe and Asia, now as well. But at the same time, I think, they recognize the need to invest, especially invest in future technologies, as the technology sector continues to intersect with every other sector, whether it's automotive, industrial products, consumer products, and staying ahead of your competitors or who your competitors might be tomorrow. So now some of those may not be as significant of investments because you're essentially making bets on a couple different business models, right? Which is one reason that I think we've seen a decline in what I'll call mega acquisition activity this year, and a lot of a pickup, say, in the 500 million to billion range. So I think CEOs have to serve many masters today, right? And it's a matter of balancing in reality as well as balancing what your messaging is to the market. But I think investment has to be a part of it.
Tony, your thoughts on stimulus for whom, whether this is aimed wisely? Yeah,
well, I think Ross's point is really important here. The need to reform the corporate side, to fix the corporate side, has been on the to-do list for Republicans on the Hill for a very long time, and it's always seemed impossible to do it. In fact, I, for the longest time, felt that it was politically impossible to do. I felt like if tax reform was only going to help, GE, you're going to have a hard time selling that, in the United States today. So you have to do a lot more on the pass-through side and on individuals, and you have to figure out something to do. And I always felt, well, we have actually done so much tax cutting on the lower quintiles, going back to 2001 in the Bush administration, and when we did it in 2001 and accelerated in 2003. They were retained in the Obama administration. You're running out of people to help, actually, right? So you have lots of cobbled together, really at the lower half of taxpayers, you're running out of people to help in ways that you can help them through the tax code. And so you have this cobbled together tax code. What they did was actually, it's not completely novel, but greatly expanding the individual, deduction, the standard deduction and child deduction. So big, simpler ways of filing taxes for people is a way to help them and to make this, at the end of the day, I think, a little bit more popular. That's the only way you can get this done. So there was a political problem to solve here in addition to the economic problem. And I think that's why they're going to be able to get it done at the end of the day.
Can I come back at you on that,
Sure.
though, on the grounds that there's no such thing as a free lunch? And one of the ways of paying for the bill is by taking away the mandate for the health program, Obamacare,
Yeah.
which could lead to its implosion. I mean, then you are taking away a lot from people who will need more help.
They see that. Look, explaining what it is, not defending it, right?
But they have part of the whole package, isn't it?
Yeah. So they see it as a feature, not a bug. All right. So I mean, it's an opportunity to try to dismantle the Obama health care plan, and they see that opportunity to do that in the tax bill. I will say the mandate has never been popular. Right? So whether there are other parts of Obamacare that have been very popular, and if you understand the economics of what Obamacare was trying to do, you understand why the mandate is important. That said, it has never polled. The mandate has never polled popular, right? So it's always been unpopular. So that's not going to hurt it, and they very much intend. Certainly, the president has been explicit on this, that he is looking for ways to allow Obamacare to fail, so that would create the pressure to come up with some kind of substitute for it. Now, I don't think that's not great public policy.
I wasn't asking you to solve the Obamacare conundrum in a panel.
But that's what their intention is.
It's a good point at which to kind of bring up this.
But there are other ways to create savings and to pay for tax reform, if you will. I mean, again, just back to overall regulation. I mean, I've seen some estimates that the cost of regulation in the U.S. is 3 times the tax cost to businesses, right? So there's a lot of potential savings if we can really continue to be successful on the deregulation front.
And Jonathan, if I could ask you on this front, President Trump, one of the big promises to business and to Americans as a whole was the red tape promise, was deregulation. And we've heard that there's already been an effect in the first 11 months of Trump. And I don't know whether that plays into what you're looking at in the sense of simplifying frameworks or making it easier to see what the potential is.
I think, I mean, regulation is good for lawyers, isn't it? Really.
Okay, good point.
So I'm kind of on it's a double-edged sword. On the other hand, deregulation is also good for us. So,
Change is good.
So from
Change generates
coming and going.
So
You can find a silver lining anywhere, can't you?
Listen, when we were looking at this, I mean, we were very fortunate. We pretty much had a blank piece of paper because we had alliances in Europe, but had relationships, but not. We hadn't merged in the US, so we were able to look at a blank piece of paper, and we spoke to UKTI, we spoke to the CBI, we spoke to a number of market research outfits and got our specific market research, and it was very, very clear. I hasten to add, this was pre-Brexit and pre-Trump as well, but the trade between the UK and the US was very strong. So, my view, governments come and go. So Brexit right now in the UK, it's a big noise. It's very important. Trump and deregulation and whatever it is Trump is tweeting today is also going to make the news. But these are we're talking about long-term investments here. I think the world is becoming a smaller place. I think the advances that we're seeing in technology, the advances that we're seeing in things like artificial intelligence, the world is a smaller place. We're all getting on planes all the time, backwards and forwards. So I think deregulation is going to benefit us all in the longer term. How long it will take, I don't know. What I can say from our experience is that over the last 15 months, we've seen significantly increased activity between our two businesses. We've seen significant opportunity in a number of different sectors. So the manufacturing sector, technology, likewise. Interestingly, one of the strategic objectives of what we did was actually to strengthen our domestic position both in the US and in the UK, and without a shadow of a doubt, it has achieved that. We've opened up 3 new offices in the US since we did this. We've opened 1 new office in the UK, and that is on the strength of the combination that we announced. So I've gone slightly off point there in terms of deregulation.
No, but actually, you've moved me on very nicely because from our pre-chat as well, I know we do want to talk about investment and we do want to talk about where it comes from, but technology and whether we should be talking about a different sort of economy. I know that's something, Steve, that you were quite keen to kind of bring forward as well in terms of what we're looking at, what we're measuring.
Yeah, and look, I'm not the economist. There are a couple on the panel here that are far more well informed on that topic than me, but As I look at it, and we've seen, the hard indicators trailing the soft indicators, as we talked about, and maybe the hard indicators are starting to pick up a bit. But, I'm just seeing much more optimism and activity than any of the economic indicators have mentioned. And, we are now on our third year of record growth, for example. And my biggest problem, frankly, is finding talent, right? Finding all the right people around the world and hiring enough. And I'm sure Jonathan
Yeah,
is
I would
experiencing the same.
absolutely agree with that.
And Tony
That's
as well.
possibly a good
So-
message to a conference like this,
Yeah,
isn't
no,
it? Talent, we need you.
It's a really good message. I mean, you look at a product like the iPhone, right? It's manufactured across 800 different suppliers. Foxconn in China being the largest, and Foxconn actually just 2 days ago, I think, announced a new plant in Wisconsin, 13,000 people they'll employ in the heartland.
Yes.
So there's just so much interconnectedness of our economies, and digital, trade is as much about digital goods and products and services as it is about physical. The way companies spend and what they outsource is so much different. So I look at it maybe as a layman on economics, and I say, do these models still make sense?
Well, I'm glad you mentioned this because I think there's been a misconception about sort of the source of why it is that we have such low real wage growth, why we have this growing disparity of income. People think, well, we just don't have enough investment, and the key is investing in more plant and equipment. But as the economy is changing, we've become a less capital-intensive type production. The service economy, you need computers, office space, and people, human capital. So the regulatory environment, to get back to that, that's part of that secret sauce to try to get what we call multi-factor productivity to grow faster. Now, what is this jargon alert supposed to be? Multi-factor productivity is what comes about when you put together the right mixture of talent, capital, and technology. And what wraps all of that together is the right regulatory environment. Yes, we need regulation because regulations are designed to address market failures, and there are a lot of market failures out there. But regulations also designed to incentivize how talent, capital, and technology mix together to produce more wage growth, more income growth, more job growth, high quality job growth. And I think that's what's been missing in the last decade. The last time we had this mixture really working well was back in the 90s. And that was the last time economists actually measured fast productivity growth. And since then, it's been drifting down. And I think part of that is because of this, the secret sauce needs resuscitating, right? Needs reviving. And I think part of that is that regulatory formula. And that's where it's hard because it's very difficult to identify how you get multi-factor productivity to rise, how you get this talent to work together, not necessarily with the guy sitting next to you, but with the guy sitting over in London or the guy sitting over in Mumbai. Those are the ways in which you can mix people in different ways to ensure that there's really faster growth in real incomes.
Maybe talent is the chili pepper.
So one of my concerns about what happened in the Senate and what got inserted at the very end deals with innovation incentives. And, a bit nuanced, complex, but originally the Senate was going to repeal the alternative minimum corporate tax. It's a different system. It got taken out at the last minute because they were looking for some revenue, I think. And what it does is it could undermine the value of R&D tax credits that major tech companies have and pharmaceutical companies. This is going to be something that's going to have to be reconciled between the Senate and the House. Having worked with much of the leadership on the Senate Finance Committee in the past on this topic, that wasn't their intention. So, I wasn't sitting behind the rooms to understand what was going on, but clearly this could be an unintended consequence if this isn't straightened out, because the last thing they wanted to do is reduce incentives for innovation, and that's the R&D tax credit. So I hope that that'll be adjusted before they eventually pass any final tax bill.
And I agree with you, but at the same time, I also wondered how badly do we need incentives for innovation? Because innovation, to me, is table stakes at this point, and investing in new technology is a matter of survival. So, to your point, I hope the R&D credit gets reinstalled, but it's just innovation is such an imperative.
And I agree. Any government that's tried to pick winners has wound up picking losers more often than winners. And that goes around the world, right? I mean, Singapore and Japan, right? Those are Asian economies that we admire because we say, wow, look at all this great, the great sectors and growth that they've been having in their past. But Singapore has had major failures. They thought they were going to be a major chemical producer. They thought they were going to be a major semiconductor conductor producer, and those all failed. And so when governments try to pick incentives and promote sectoral growth, that's where there are red lights flashing all over the place. The market certainly has to be the source of where the asset allocation is, and getting rid of the distortions in the marketplace is really critical to doing that.
Your customers will pick the winners.
Absolutely.
That's right. Yeah, I mean, the key that's the key, right? I mean, if you can ensure that you've got remove frictions on the movement of capital and people and ideas. Investment. I mean, if we have a problem of insufficient domestic investment, we'd love to see a lot more foreign direct investment and being as open to that as possible. I still think at the end of the day, the economies that commit themselves to that level of openness on all of those things, on people, on goods and services, on capital, and ideas. They're gonna. Those are the ones that are going to succeed in the long run. I worry a little bit about the United States because we're throwing sand into the gears on each of those things. Maybe the least is on ideas, but on the other three, on talent, on trade, and on capital, I think we're throwing sand into those gears.
And let me add one more thing to that, because this is Milken after all. The Milken mandate is to increase access to capital in order to finance job growth and good health. What does access to capital mean? Mike often says, get the capital structure right? Get the right capital structure, and you will be able to have capital flow to the best uses and be used to increase employment and good health. But what we've been doing here at Milken is to look at what capital structure promotes productivity growth. And what's interesting is that if you look at the growth of debt and the growth of investment and productive investment, that's starting to diverge.
You get that crocodile.
And what's fabulous about these results is that, in this low interest rate environment, what have firms been doing? They've been issuing debt like crazy. And the more debt you have out there, it seems, to take away from the productive investments that we need to enhance productivity. And so if you go back to the 1980s, remember Michael Jensen when he said, if you load firms up with debt, you push managements back to the wall, and they're going to be much more productive and much more efficient. Well, the corollary to that wasn't so well publicized was, if you're a manager, you've got all this debt service, you're scared out of your mind, and so you're going to be going for tangible investments so that you can pay back these debt holders, and you're going to be going for safe investments. Yep. That's exactly the wrong formula for today. You need firms that are willing to take big bets, productive investments, make a gamble, and say, state of the art is there. The world's not there yet, but I'm going to go there because that's where the payoffs are going to be in the next 5 to 10 years. And that you need to have incentives to get a lot of upside. What gives you a lot of upside? Equity. So it's really the reverse of the M&A philosophy of the 1980s, where you load companies up with debt to make them more efficient. In fact, you should, I think, incentivize them to reduce some of that debt, right? Because after all, they're issuing debt right now and giving it back to shareholders. They're certainly not being productive with it. But if you incentivize the right capital structure and the right regulatory environment to go with it, I think that's where the secret sauce for faster growth and higher productivity will come from.
Philippa, just on one point on R&D, we did a piece of research earlier this year, and I think everybody agrees technology is critically important to the future success of business. But one thing we observed is that traditional route into R&D, where you set aside a lump of your profit and you do it internally, actually that is reducing, and what we're seeing much more of is collaboration, particularly between large organizations and small organizations. Mm-hmm. And we're seeing that not just on a domestic scale, but also on a global scale. And that's driven because large organizations recognize they're not as nimble as they can be, whereas smaller organizations are. And technology and the innovation that we've talked about before, you often see that in the smaller organizations.
No, that's exactly right. You're seeing much more partnering, much more strategic alliance activity, much more minority investment, many more corporations starting venture capital arms again, to make some of those informed bets.
And so many of them start out as private companies, right? And so that's why private equity has become such an important part of the food chain for feeding capital into the ventures that really can give us the productive investments of the future. And private equity, though, is the danger there is it lacks the transparency from a regulatory side and from the public side, so that what on earth is going on there? What is this black box, and how can they promise returns that are 150 to 250 basis points above what the market is supposed to be giving you? And the fact that they're promising that, it's incentivizing firms to leave the public marketplace where there is transparency in the management and going into this private equity world. And that, to me, is one of the danger signs that regulators are worried about, and something that we at Milken are certainly
Ross.
looking into.
Go ahead. Well, private equity is, I agree with, big trend, and Michael said this, 7 out of the top 10 employers in the U.S. are private equity complexes. I do think the dialogue is changing with private equity. Longer tenured funds are becoming, changing how these funds can invest and sort of what their growth and value creation strategies can be. It's much different. You can hold an asset 10 or 15 years versus 4 to 5 years. We've been talking to PE about this notion of what we call positive equity, right? And what is the overall impact that private equity has on society? And I think PE funds are recognizing that they can't just stay in the black box forever.
Yes.
So, sorry.
Yeah, they're fine. I was going to point out that, one of the key distinctions from this recovery relative to previous ones is the rate of entrepreneurship and startup of new companies has fallen off relative to where it was even prior to the technology bubble bursting in the early 2000s. Now, the good news is that we're starting to see that change. One of the concerns there is we don't have enough patient capital, and that's one of the initiatives that we have in looking at the center of the country is we need to have more confidence, and because startup companies tend to be at the leading edge, they're the interrupters, and I think we're starting to see that shift. There's a bit more confidence in that market now, but I would argue, back to Bill's point, how we're going to get more productivity growth and multi-factor productivity growth, throw in a few more economic jargon, that is really important moving forward.
Yeah, and I agree. It's nascent. You're starting to see some additional sources, but we need more.
There's a bit of an elephant in the room in terms of Chinese investment. This is an economic issue, and it's a political issue, obviously, given the president's views on China, Chinese investment. And is it something, just thoughts on whether it is happening, it is to be welcomed, Chinese FDI, or there's going to be a shuddering halt at some point?
I don't think you can afford a shuddering halt. Certainly this year is down dramatically in terms of outbound Chinese investment from what it was in 2016. Now, if you look back over the last 5 to 10 years, it's actually not that far off the average, but 2016 was a pretty strong year. We've talked about CFIUS in the U.S., and that has held up a lot of transactions, and there are a lot pending review, a lot that have been slow-tracked. CFIUS stands for
Committee on Foreign Investment in the United States, and it's the national security review of sensitive acquisitions.
And there have been proposals on rewriting the mandate of CFIUS that have, I think, just recently been introduced in the last 30 days. But if you look at last year, I think there were 4 or 5 transactions that were halted. This year, over that, more than that already year to date, and we've heard some high-profile ones. But more
presumably you're talking about a lot of money in these transactions.
Yeah. More importantly, are the ones that have been slow-tracked, right? Like an Oceanwide Genworth, for example. They've been slow-tracked, kind of trying to work with and figure out the right path to completion. The average, if you look China to U.S., the average transaction this year has just been $100 million. So 80 have been done. But the average transaction size is 100. I think the largest is $1.5 billion, maybe. Yeah. So look, that's not sustainable. Absolutely not sustainable. China is going to be the largest economy in the world by 2030. Any of you that have spent time in China understand, the determination and drive of the people in China, the innovation that's happening, the entrepreneurship. It may not be a bad thing that some of the outbound activity is slowed in the near term because China has a lot to do in terms of consolidating their SOEs. There's a lot of efficiency to be gained from doing that, and those of you that have visited SOEs will know what I'm talking about there. So probably a good chance for China to get their house in order as some of the ground rules get negotiated on the cross-border.
But Tony, when you spoke about throwing sand in the gears, I don't know if you meant at this level, but
Yeah, it's a piece of it. I mean, obviously, on the Chinese side, whether there's outbound investment is to some degree, whether we'd love to see that more market-oriented rather than fiat, the state sort of guiding their investment decisions. But clearly, we benefit. We want the Chinese investing everywhere, and including the United States, and it's a great benefit to the country. It's good for China. It's good for them to establish global brands and to become more integrated in the global economy. I think it's good from an economic standpoint and a national security standpoint. In the United States, I think about when I was back at I was at Treasury Department 10 and 12 years ago, and we were looking at these kinds of transactions, and we did the Lenovo transaction, which was Lenovo buying IBM's laptop business. This is in a period of time where we had the CNOOC was prevented from buying Unocal in California in the energy space. Dubai Ports World was prevented from operating certain U.S. ports that they were going to purchase, and this was also in a time where I think the very start of where it was getting really hot about concerns about the Chinese currency also. But we were able to complete this transaction and allow it to go through with certain, some mitigation and requirements that Lenovo had to do. It was a win-win for everybody. I mean, Lenovo is a very successful company. They're I think, the most successful, laptop producer in the world right now. They make a terrific product. It's great to have these still made in the United States. So it was a real win, and it's maybe the most successful Chinese global brand right now is Lenovo, so which is also very good for China. I think the chances of trying to do that transaction today in this current political environment are something near zero. If you were going to try to have a Chinese company buy an American hardware company today, almost impossible to do in this current political environment. And so that's a lose-lose for everybody, right? Just really, really bad for our economy, for the Chinese, for a lot of these firms. So that's what I worry about.
I'm going to open it up to questions. In fact, I might do that now. I'm going to come back to ask you all for predictions or something that you think the audience should be watching in your kind of final thoughts. Just want to see if anybody has any questions, and I can't really see, but shoot your hand up if anybody does, or if you're just loving the flow of conversation, we'll carry on with it. Well, if I see any hands go up at any point, I'll try to get to you. There we go. Are we bringing a mic forward? We are. If you would just tell us who you are and where you're from, that would be great.
Thank you. Trevor Castledown from Local Pensions Partnership. You asked at the very start about the score for the US economy.
I'm a journalist, I couldn't help it.
No, I mean, I think that's good. And we have 5, wealthy, middle-class individuals who have good jobs, who are very optimistic. I mean, as a little thought experiment, if you were looking through the lens of a blue-collar worker in the middle of the States, would you have the same score?
Clearly, I wouldn't be where I am at today if the answer to that question is they're not concerned. There is a great deal of concern. It was out of frustration, partly, that many of the blue-collar workers that typically would vote Democratic in the United States flipped and voted Republican to some extent, and it switched some states like Wisconsin. So there is a lot of concern, the inequality. If anything, the tightening labor markets in the United States, I think we're at the point now, we've been saying this for a while, but it's right at the margin that they've gotten so tight. Talent, labor is hard to attract, and we're starting to see some of the largest wage gains in some of the blue-collar professions in the United States. It's still very early, but there is the hope and anticipation that those pressures will build and hopefully reduce some of the inequality that has been generated in the United States.
And I think you're also seeing, I agree with that 100%, and I think you're also seeing jobs change, right? And that creates uncertainty, and that creates discomfort that goes along with the uncertainty. But even the types of blue-collar jobs are changing, right? I mean, an old line manufacturing type job is different than Foxconn coming in with a 13,000 person plant in Wisconsin.
And especially if you're older, you've got reason to be really worried.
Yeah. So it is, but you know, and this may sound like a comment from one of the successful people on this panel, but you look at where the stock market is today, and at the end of the day, that is benefiting everyone through pension plans, pension investments, you would hope, and many. So the discomfort's certainly there. They probably, a lot of the people in the heartland, blue collar, may not rate it as high as we would, but I think there's reason to be optimistic.
I'm from Pittsburgh, so I grew up in a blue collar neighborhood. I was, first generation to go to college, and I go back there a lot. Still own a home back there, and spend a lot of time with them. And I'll tell you, that was Trump country. It was like very much if you were looking for the prototype Trump voter, those were my neighbors in Pittsburgh and kids that I grew up with. So I feel like I have a good sense of it. They feel like they've got someone who's fighting for them, even if, and this is again another paradox, even if they don't even believe that the solutions he's advocating for are going to bring them relief. I think they even understand that the world is more complicated than the way he describes it, but they like the fact that he's fighting for them. They're nervous about lots of different things. Some of it is globalization. Some of it is every day reading and seeing and hearing about AI and how their jobs are going to be eliminated. And there's one other thing, is that they also understand that the problems are very complicated for them also, in that they see things like they hear about all of these blue-collar jobs that require some skills that are available, and they also know that the biggest hurdle for people getting those jobs right now isn't their trainability or access to training. It's the ability to pass a drug test.
That's exactly right.
Yeah.
You hear that from so many.
It's unbelievable.
Especially in parts of the Midwest. I mean, it's a big issue.
Yes, that is huge. I'm going to actually good question. Thank you. I'm going to ask for, I think a few hands went up, and maybe we'll get 2 or 3 questions at least voiced that our panelists can then pick up on. Remind us who you are.
Thank you. Yes, my name is John Jones, and I chair some local authority pension boards here in the UK. Like Trevor, I was struck by your marks for the US economy, 8 to 9s and 10s. But my question really is about asset prices, and are public markets overvalued, and can we anticipate a correction in the coming year?
Thank you. And I'm just going to see if there are any more hands. I can't see, and I think, the word bubble was one I was going to
That could be
use.
one of our prediction.
Yes, well, why don't we? Why don't we move it ahead? And who wants to pick up that idea about, is a correction due?
So I don't believe asset prices are greatly overvalued. I think that earnings fundamentals are strong. I think we're still understanding how to measure the productivity of this 4th industrial revolution and the kinds of business opportunities that are being created. So I don't see a major correction, other than if we were to see some global systemic financial shock, which is hard for me to understand what that would be. So I sort of stick with my original
I think you've got more confident as the panel's gone on.
I might have. I expected Bill to be a little more negative, so he's got my confidence level up. No, I'm still worried about trade, and I still worry about the drag, the near-term drag, if we don't get some of the trade matters figured out. And I understand it's probably just tough negotiation, but we need to get on with it.
We also have to keep in perspective that even though the Senate passed their tax reform bill, we don't yet have something signed into law.
Yep.
And on the Senate side, you have to understand that the Republicans only have like a +2. They lose 1 or 2 votes somewhere in the reconciliation process, and that could still go wrong. And I say that in response to the question, which is markets have been anticipating, discounting the probability of tax reform, but there is some of that already built into current multiples. And so I think if we didn't actually have a tax bill signed into law, especially didn't have the business tax reform, then I think there's a strong possibility of a pullback.
As someone who's worked in financial markets my entire professional career, both at the Fed, the IMF, and for Citibank as their chief U.S. economist for the last 6 years before coming to Milken, I feel compelled to say to you, asset prices are incredibly high, and I worry about that a lot. Why? Because why were they driven up so high? Global monetary policy set interest rates towards zero, or in the case of Europe, negative interest rates, and that distorted financial markets to the point where asset prices reacted in an extraordinary way. And it was by design. Global monetary policymakers around it said, we can't get the economy going, so we're going to make things cheaper and cheaper. We're going to make asset prices higher and higher so that people will start spending. Did they? We still have yet to see a robust recovery. So it's one of these questions where I absolutely agree with you. It's something I worry about a lot because it has introduced so many distortions in the capital markets that the possibility of allocating capital to the most efficient uses, I think that is a hope and a prayer right now. So for me, that's the heart of the question of vulnerabilities going forward. And if I were to start the prediction about the future, the thing I worry about most is whether or not monetary policy globally will be able to right-size itself, to normalize in a way that allows markets to adjust slowly. And in fact, every policymaker out there said, we're doing it very slowly. The word gradual is the most overused word among policymakers around the world. But telling you that it's going to be gradual isn't very helpful for investors or investors in the financial markets, because where are they going? What framework are they using to say, this is how we're setting monetary policy and this is how we're going to change policy in response to changing data? All they're telling you is, we're data dependent, we're certainly going to change if the world changes, and we're going to do it slowly. But where are they going? Where's the framework? And that is something that I was hoping the Fed would be able to put in place with a guy like John Taylor, who had a clear framework about where things are going to be going. And right now, we have a monetary policy around the world driven by a seat-of-the-pants approach.
Seat-of-the-pants approach. Tony, your thoughts about where we're going?
I think sometimes Uncle Sam, falls down the stairs and then lands on his feet, and I think that's kind of where where we are. Because I agree with that. This is something I've been saying for a long time. Is that getting back to normal monetary policy is we've never done this before in this way. It's complicated. Getting the timing right and the magnitude right, I think, is very difficult for humans to do. We make mistakes when we do things the first time, but we are in a tightening cycle for monetary policy. Might not be the worst time to be in a looser fiscal environment. By sheer luck and politics and whatever, we may be in a situation where we're looser on the fiscal side while we're in a tightening cycle on the monetary policy side, and Uncle Sam sticks the landing again. So
I'm kind of getting the feeling that we're dancing on a tightrope with smiles on our faces, feeling from the panel. Jonathan, you're bringing us back home, aren't you, with the transatlantic hat that you have?
Yeah, we haven't spoken, reassuringly, we haven't spoken about uncertainty so much today, but, we do live in this incredibly uncertain world. We've got uncertainty in Europe. We've got, we never quite know when we turn the news on in the morning what might or might not have been happening in the Brexit negotiations. You never quite know what Trump's going to have tweeted overnight. You're worried about what's going on in Korea. These are all big picture things, and ultimately, I'm afraid none of us can control these things ourselves. And what I see on the ground are lots of confident people who believe that we have a good and strong future. Prince Harry is doing his bit for Trump.
That's right. Cheers for Prince Harry. Some kind of Shakespearean adaptation there. Well, that means you will have to come back next year, doesn't it? If we were saying, we can then have intelligent thoughts about what has gone on in President Trump's second year. Thank you all so much for being here. And Tony, Bill, Steve, Ross, Jonathan, thank you so much for being my panel today.
Thank you.